Welcome to Navigating the Transition, Adopting Principles-Based Bond Accounting for Statutory Insurers, presented by AAM's Investment Accounting Team. Our team consists of myself, Stacy Crook, Principal and Director of Investment Accounting, Maria Beltran, CPA, Senior Investment Accountant, and Eric Pochyla, Senior Investment Accountant. Today's agenda will cover the background, updates to Schedule D Part 1, the transition process, implementation strategies, and a concluding summary. The Principles-Based Bond Project emerged from the Working Group on Investment Classification Project, aimed at clearly defining what constitutes a bond. This initiative marks the most significant change in reporting in decades, adopted in August of 2023 with an effective date of January 1st, 2025. Three critical factors underscored the need for a principle-based bond definition. The previous SAP was focused on the legal form rather than substance. The risk-based capital incentive to classify assets as bonds, and the growing complexity in investment portfolios that complicates regulators' assessment of bond risk. The objectives of this new approach include providing a framework that embraces an innovative bond market, evaluating securities based on substance rather than legal form, and enhancing transparency for regulators regarding the securities held in insurers' investment portfolios. The principles-based definition includes three key elements: classification driven by substance, the responsibility of the reporting entity to classify securities accurately, and the understanding that designations from the NAIC or credit rating agencies do not dictate investment classification. Our focus today will be on the revisions to Schedule D Part 1 for long-term bonds and how these changes will influence the accounting and reporting for long-term bonds. I will now hand it over to my colleague, Maria Beltran, who will discuss the updates for Schedule D Part 1, Section 1 concerning issuer credit obligations.
Thank you for joining. Today, I will be discussing the revisions to Schedule D Part 1 as outlined by the NAIC. Effective January 1, 2025, Schedule D Part 1 will be divided into two sections. Section 1, Issue Credit Obligations as defined by SEP 26R, and Section 2, Asset-Backed Securities for SEP 43R. The divided sections are designed to reflect the different risks of each bond type. These changes are intended to implement a principle-based bond definition, shifting the focus from legal form to the substance of what qualifies for reporting as a bond. New bond definition. SEP 26 for bonds defines a bond as any security representing creditors' relationship with a fixed schedule for one or more future payments and qualifies as either an issue credit obligation or an asset-backed security. These principles are based on cash flow, creditworthiness, and contracts, reflecting the issuer-bondholder relationship. Securities must be evaluated to determine their classification as bonds, equity, or other categories. Securities not meeting the updated bond definition will be reclassified to Schedule BA or another appropriate schedule. Key note: is the security a bond, equity, or something else? Luckily, we do not expect significant transfer of assets from D1 to BA. Core principles of a bond: issue credit obligations and creditor relationship. Issue credit obligation is a bond for which the general creditworthiness of an operating entity or entities through direct or indirect recourse is the primary resource of repayment. Eligible operating entities may include businesses, not-for-profit organizations, governmental units, or other provider of goods or services, but exclude natural persons or asset-backed security issuers. In addition, it also includes single entity-backed obligations, as well as funds that represent operating entities. SEP 26 specifically scopes in these securities and will continue to be reported on Schedule D, Part 1. Creditor relationship. Components that establish a relationship between the issuer and the insurance investor. Repayment is primarily dependent on the creditworthiness of the operating entity. All interest and 95% of principal payments backed by a single operating entity. Principal and interest payments, fixed or variable, must be contractually predetermined and not contingent upon the performance of the underlying collateral. Keynote: debt instruments collateralized by assets with contractual cash flows. Exceptions: the new guidelines do not restrict plain vanilla inflations, benchmark interest rate adjustments, or scheduled interest rate step-ups. Securities that do not qualify as issue credit obligations are listed below. A security that has equity-like characteristics in substance or represents an ownership interest in the issuer does not establish a creditor's relationship. Structured notes and principal protected securities are examples of equity-like securities that do not meet the bond definition. Here is a list of the security types that will be included in Schedule D, Part 1 within the scope of SEP 26R. Securities includes U.S. government obligations, municipal bonds, corporate bonds, and so forth. Most of us are familiar with these security types. The good news is there will be no changes in reporting for these securities under the bond principle. These securities have historically been classified as bonds, and we will continue to maintain our current reporting practice. Thank you for your attention. I will now hand over the discussion to Eric.
Thank you, Maria. I'll be going over the Schedule D, Part 1, Section 2, which covers asset-backed securities. Asset-backed securities are referenced under SSAP 4.3. They used to be referred to as loan-backed securities or structured securities. These are now just called asset-backed securities. As mentioned, the main premise of this revision is substance over legal form reporting. To define asset-backed securities, they have an underlying collateral and repayment from that source. These are commonly thought of as mortgage-backed securities. On a more specific level, there are residential mortgage-backed securities, commercial mortgage-backed securities, collateral loan obligations, and other financial asset-backed securities. It should be noted that these securities are not reported on the Schedule E, which are cash equivalents, or Schedule DA, which are short-term securities. For asset-backed securities, you need to determine if there is a substantive credit enhancement to see if there will be a financial asset-backed security or a non-financial asset-backed security. If the answer is yes to substantive credit enhancement, then it should be considered a bond. For the non-financial asset-backed securities, we are looking for a creditor relationship, substantive credit enhancements, and they also need to meet the meaningful cash flow criteria. For meaningful cash flow criteria, you look for assets that are looking for a repayment of a bond. Examples would include use, licensing, leasing, servicing, or management fees. For credit enhancement, this can be thought of as a cushion that absorbs losses on underlying assets. Examples of credit enhancement include guarantees, tranches, or over-collateralization. As you go down this list, there will be more judgment involved. AAM will advise, but this ultimately falls on management on which to decide. For the next slide, I'll go over a couple of the new columns. There are 6 new categories. First one being payment due at maturity. Second is origination balloon payment percentage. A balloon payment is a far larger than other payments that is not required for self-liquidating assets. Third is over collateralization percentage, then origination expected payoff date, then aggregate deferred interest, and then paid in-kind interest. Then we go to the 3 revised columns. First being investment characteristics, second being agency sovereign jurisdiction or state abbreviation. These only need to be populated by ABS securities that fall under RMBS and CMBS securities. The third one being collateral type. The 2 that are eliminated are the same from the D1, the original D1, which include the rate used to obtain fair value and then LEI code. After this, I'll hand this over to Stacy.
Thank you, Eric. I will proceed with the reporting updates for Schedule D Part 1, Section 1. As Eric just discussed, the changes for Schedule D Part 1, Section 2, it's important to note that Part 1, Section 1 has 3 fewer new categories, while everything else remains consistent with our previous discussions. Now let's address the transition to the principles-based bond definition. The NAIC has created a helpful bond principles flowchart to assist insurers in determining whether an item qualifies as a bond, as well as identifying if it is an issuer obligation or asset-backed security. This flowchart includes guiding questions to help navigate the classification process and ultimately establish whether it is a bond or not a bond. Insurers are expected to make their best efforts in assessing whether an investment is categorized as a bond. It is understood that these evaluations may be subjective. These assessments should be based on the acquisition date when possible. If that information is not available, current data can be used. Once insurers determine whether an investment is a bond and where it should be classified on Schedule D, no further evaluations are required unless prompted by an auditor or a state regulator. For investments moving to Schedule BA, you should process a disposal from Schedule D Part 1 at amortized cost and a purchase to Schedule BA at amortized cost with an effective date of January 1, 2025. These transactions should not result in a realized gain or loss. If the investment is recorded at fair value on Schedule D Part 1 and needs to shift to Schedule BA, the unrealized amount should be reversed and the disposal should be processed at amortized cost to avoid realizing a loss during reclassification. The investment will then be recorded on Schedule BA at amortized cost with no unrealized gains expected from the reclassification. The measurement on Schedule BA follows lower of cost or fair value. The definition is applied prospectively and there is no grandfather provision. Next, let's discuss how AAM will implement the new principle-based bond definition for reporting. The good news is that AAM has already begun this process. Together with our service provider, we are working behind the scenes to ensure everything is set up using a phased-in approach. As you navigate this process, consider the following. First, general ledger entries, and second, whether you have the appropriate support to assess the investments. Regarding general ledger entries, if they are based on stat classification, will you separate D Part 1, Section 1 and Section 2, or will you present them as a combined entry? If your entries are based on NAIC categories, which are undergoing changes, assess whether that level of detail is necessary, or if it suffices to have journal entries at the bond level and utilize reports for further granularity. Finally, it may be helpful to develop a checklist outlining the necessary steps for compliance and establish a standard operating procedure to share with your auditors and your regulators. Additionally, please be aware that the NAIC is offering free training until December 31st, 2024. The course is entitled EDU 350-118 Principle-Based Bond Project Training. Thank you for your attention, and if you have any questions, please feel free to use the Q&A feature during the webinar or email me at stacy.crook@aamcompany.com. Thank you for joining.